Thanks for listening to A Long Time in Finance with Jonathan Ford and Neil Collins, in partnership with Briefcase.News, the service that brings intelligent curation and analysis to your media monitoring. Many people think the UK housing market is in crisis. We don't build enough new homes, and prices are insanely high. Houses cost almost 9 times average earnings, up from less than 4 times in the 1970s. And if you don't work for a bank or have an account at the bank of mum and dad, basically you can't afford to get on the housing ladder. But how did we get here to a world where owner occupation is declining from a peak of around 70% around the turn of the millennium to under 65% today? And one where, for many people, their home has become their most important financial asset. What's behind the growth of the private rental market, which has rebounded after long-term decline post-1945? And why do we build so little social housing? In a 2-part series on the history of the UK housing market, we thought we'd start by looking at housing finance, which, until the 1970s, the UK operated a mortgage system that was largely closed and sheltered from market volatility. Since then, it's been opened up to competition, both domestically and from abroad, leading to much higher prices. So we thought we'd look at how the UK mortgage market has changed over the last 30 years to see whether those changes contributed to the malaise. And we're joined by Mark Boleat, who has been involved in housing finance since the 1970s. He's been at various times the head of the UK Building Societies Association, head of the UK Council of Mortgage Lenders, and also Director General of the International Housing Finance Union. Mark, welcome.
Thank you.
People often talk about the past as a golden age where young people could buy a house and the market functioned well. Perhaps you can give us a sense of how it all worked back in the mid-1970s and whether that's really an accurate picture, whether there was this golden age.
I don't think it was called a golden age at the time. Indeed, some people think we're permanently in a housing crisis. There were times in the 1970s when buying a house was easy, the early 1970s. Then we had a big slump caused by rising interest rates, and prices fell very substantially in real terms. And then people were able to buy again. So the sort of people who were able to buy then can't buy now. So even I was able to buy my first home with a 95% mortgage on a reasonably modest salary in London. That would just not be feasible today.
Just one thing which strikes me looking at the market structure as it existed in the 1970s was how small a role the high street banks played in the mortgage market, which meant that the building societies had it mainly to themselves. Can you explain why that was?
Yes, but you should not assume there was some great plan.
Yeah.
This was a consequence of other policies. The building societies were not regarded as being relevant really to anything. They were not banks. They were not subject to banking regulation. They were seen as being pretty small organizations that dealt with a bit of the financial system. Bank deposits were regarded as being money, and the government had a method of controlling the economy, not very effectively, by controlling the growth of bank deposits, something wonderfully known as the Corset. And this meant the banks were limited in their ability to grow their balance sheet. Building societies were not. So they effectively had the market to themselves, and it was a rapidly growing market. So nobody in government said, hey, we've got a great idea, let's stop the banks lending and let's build up the building societies. That is what happened, but it wasn't a consequence of any overt government policy.
It was effectively a cartel, the building societies at the time. The rate was essentially set by a committee of the societies, if I recall. That was what mortgages cost. There was a bit of bank activity, oddly enough, through mortgage brokers who were keen to sell you endowment policies. If you bought an endowment policy, you could then have a bank loan. And I did that for my first house, probably about the same time as you did, Mark.
Where was your first house?
But it was very much a minority sport. It was in London, yes, in Bow, which was very unfashionable at the time. The market was essentially run and controlled by this cartel. Let's not call it anything else. The interesting question, of course, is whether that actually worked quite well. it's anathema to those who believe in competition. But looking back, it wasn't such a bad system.
It wasn't just the banks that did endowment loans. At that time, the bulk of building society loans were also endowment loans backed by an insurance company. The building societies benefited massively from commission from the insurance companies. It was a cartel, a very effective cartel. I know, I ran it. I was the person who did the analysis and produced the figures.
Speaking to the boss.
We had great time. We sat and pontificated, and the media were camped outside waiting for the white smoke to say, and this is the mortgage rate, and this is the savings rate. And it was encouraged by the government. But a cartel can only work if you can keep outsiders out. And at the time, the outsiders were kept out. And of course, the cartel fixed rates at an ideal level to suit the building societies. It fixed the margin at higher than would apply in an open market, which is why you had a proliferation of building society branches. But yeah, it was a cartel, and it meant that the mortgage rate was held below a market clearing level, which meant there were queues. And it's much easier to run a business if there is a queue.
Yes.
You don't have to bother about demand. Indeed, we had a saying that you ran the building society on the 5-7-2 principle. You paid your depositors 5%, you charged your borrowers 7%, and you're on the golf course at 2:00.
Can I just interject for our younger listeners? The concept of an endowment loan, if I understand it correctly, because they're not very fashionable these days, this is basically a loan where the repayments are supposedly dealt with by an insurance policy through which you save, and the proceeds of the endowment then pay off your loan. Is that correct?
That's a pretty good description.
But I want to move on. We're into this Garden of Eden, that we're describing from the 1970s with a cartel, queues everywhere, relative stability and peace. All of a sudden, this whole system starts to break up. And I'm interested in your take on what broke it up and whether that breaking up, which takes place, I would say, from the late 70s onwards, is a positive development or not.
Again, there was no plan. The government had tried to control the economy through monetary policy through this thing called the Corset. The government also had exchange controls, which older people will remember.
How did that function?
Well, you could only take £50 when you left the country to go on your holiday in Spain. But of course, people get round controls, and eventually exchange controls were abolished. And the effect of abolishing exchange controls was that using the restriction on the growth of bank liabilities to control the economy was simply ineffective. So that control had to be lifted. Again, it wasn't a positive policy. Let's allow the banks to compete in the mortgage market. Rather, because of the abolition of exchange controls, the constraints on the banks had to be removed. And the banks immediately saw, well, we should be in the mortgage market. That is a natural market for retail banks in every other country. So the banks obviously wanted to get into the mortgage market, and they did in a big way. That meant that the mortgage rate, instead of being set by the cartel, but obviously influenced by the market, that meant that the cartel simply stopped operating, that we had to start changing the mortgage rate in line with market rates, because otherwise the system didn't work. So that's why it changed. It was simply one policy measure led to another, which freed the banks to come into the mortgage market.
And in the short term, presumably that's a positive thing for consumers because the queues disappear and it's easier to get a mortgage.
Absolutely.
And cheaper, presumably.
It was modestly cheaper. Although we had the cartel, you can't have the mortgage rate at 5% if interest rates are at 10%.
They had to compete on price. That was the point, where they hadn't done before.
I mean, there was limited competition on price because it's a near perfect market. If a mortgage lender was offering 20 basis points below the market, they'd be inundated with business. So the reality is that it settled at a market rate with differential rates depending on risk. So the higher the percentage loan, there could be a higher mortgage rate.
One of the striking points for me about the 1980s is that best way I can think of, and maybe I'm wrong about this, to look at the relative price of housing is just looking at it through this affordability measure, looking at house prices versus earnings. And you go right back into the midst of time, houses are very expensive. In the 19th century, they're 12 times earnings, which is why you have a very large private rental sector. But by the 70s, we get to this plateau, which seems to be a very long-term trend of around 4 times. In the 1980s, you see, I suppose it's the Lawson boom. House prices do rocket in the mid to late 80s. Basically, they go up to about 6 times. And then you have the crisis of the early 90s, and they drop back to 4 times, which is where they kind of sit. I'm interested in the fact that seems to suggest that banks have this broad kind of rule of thumb in operation, which is that somewhere around 4 times is the right level at which to underwrite a mortgage loan. And if it goes too much out of whack, you have a correction, as you had in the early 70s and then in the late 80s. And otherwise, the market sticks at a constant level. Is there anything magic about that number?
Nothing magic at all. Yeah, you're right generally. And I did a lot of work with other people on house price determination. We actually published a book on it. Generally, the house price earnings ratio was considered to be the key point. But in a way, that's true if interest rates are stable. It's very different if interest rates are very different. So, we were used to interest rates at that time into double figures, and certainly nothing below 5%. Now, clearly, if interest rates fall, then it's quite feasible that you can afford a house that's twice as expensive because you're paying half as much for the loan. The other factor, which I think has become increasingly important, is the bank of mum and dad. Now, it's sometimes said that prices are beyond the reach of people's ability to pay. That is an absurd statement. Prices are paid by people who can afford to pay them, and the banks will lend money only if they think people can afford to repay the loan. This then comes back to the biggest single cause of the housing problem in Britain, and it's about planning. If you constrain supply, prices will be higher. And that is what successive governments have done.
Yes, I don't think it's been a policy. It's been sort of by default, because all the fine words about how many they're going to build were actually just that. They were fine words because really successive governments had no real intention of building houses because it upset their constituents. NIMBYism has been a very powerful restraint on building houses for quite a long time, over several governments now.
Yeah, if you're an individual member of parliament, you do not want development. There's also a view that the Conservative Party was very happy to see very high house prices because it believed that that would help it electorally, because the elderly are more likely to vote Conservative. So there is something in that. But yes, the whole system is geared against development. Every government talks about taking account of the views of the local community, which means taking account of the people who have housing, not the people who do not have housing.
Can we just go back to the 1990s? Because we come through the 80s, there's a housing slump in the 1990s. It looks as if the sort of market has settled down. But the one big change that does happen in the 1990s in the mortgage market itself is that all the building societies, or all the large ones, start to go public. They demutualize, they sell themselves to the stock market or to other banks. What impact do you think this had, if any, on the development of the market? Did it change anything, or is it just a kind of clearing out of defunct institutions?
I don't think it had a major effect on the mortgage market. It clearly had a major effect on the building societies. The demutualization was not a stunning success. Because the banks had been freed to operate in the mortgage market, you then had building societies that were constrained because they could only operate in the mortgage market. And the Building Societies Act 1986 freed them to do a lot of other things. But the key point was they weren't very good at it. It was a doddle to run a building society with a cartel, only doing two things, which were quite simple. When they started getting into other lines of business, for example, unsecured lending, they found it wasn't quite so easy.
So let's turn to the 2000s, which is the kind of key period, which is when you see affordability numbers going up substantially higher. You've mentioned one factor, which is that interest rates come down after 2000, and that makes it mortgages seem more affordable on an income basis, because simply the cost of the loan service is much lower. Are there other factors in play which, in your view, kind of change the perception of how much it's prudent to lend against a house? And is there not some evidence that the approach to lending that's being taken is supporting higher prices at this point?
I must say, as an economist, I have a lot of difficulty with that notion. Because somebody's willing to lend you money, the notion you're going to therefore borrow it is nonsense. People bought houses because they thought it was a good idea to do so. And you talked earlier about the housing ladder. There is an assumption that house prices can only go up. Now, we've had two periods where they've gone down massively in real terms. And in the early 1990s, they went down massively in nominal terms. And that can happen again. It's happened in other countries. People thought they needed to be on the housing ladder, and therefore they were prepared to borrow money. And the Bank of Mum and Dad, in many cases, was immensely helpful. And the Bank of Mum and Dad has grown massively in importance because house prices have risen. But you do have a group of people who don't have a Bank of Mum and Dad, and it's a large group of people. So you are really moving into a bit of a two-tier market where those with well-off parents can enter the market, those without, a bit more difficult.
Yes.
I mean, it seems just absolutely straightforward, logical. If you can afford to get your offspring into some decent accommodation at a price that they can afford, and if you pay the deposit, it's just obvious.
That's exactly how people think. House prices are outrageously high. I must therefore help my children to pay them. Yeah, that's why they're outrageously high. If we didn't have a Bank of Mum and Dad, if people had to use their own resources, I'm sure prices would be lower.
So you'd have to confiscate the assets of Mum and Dad to prevent them passing them on to their children.
Yeah.
It would produce a geriatric revolution in the streets.
Yeah, a sea of white hair coming down Whitehall. There's another aspect to this which we want to talk about beyond the Bank of Mum and Dad, which is the whole development of the buy-to-let mortgage market. We started off by saying that the private rental sector in the first half of the 20th century, or really up till the 1970s, is in decline. And then, to some extent, supplanted by home ownership and also by council housing, social housing. And then in the 1990s, private rentals sort of makes a comeback. I'm interested in what drives this and how this changes the mortgage market in terms of clearly the buy-to-let sector becomes a big growth area, if you like, for the mortgage industry.
First of all, I can assure you that nobody in government said, let's have a buy-to-let sector.
Oh.
So going back to the 1970s, when I bought my first house, there was no rental market because of controls on the rented sector, security of tenure and rent controls. And they were progressively removed. And the way that was done was sort of a number of surreptitious moves, which Labour strongly supported. So the big growth of owner occupation and the high level was unnatural. It was a consequence of restriction on the private rental sector. As those restrictions were eased, you naturally had a reaction that people who preferred to rent did. The buy-to-let market was partly a consequence of that. But also people saw housing as a good investment. They could buy on a relatively low rate of interest, they could get a market return, and they'd get a growth in the capital asset. And it provided valuable housing. So that's why the market grew. It was not a policy decision. It was a consequence of other policy measures.
And they were also able to effectively get a sort of tax shelter by borrowing to buy the house, right?
In my view, that's not a tax shelter. They were providing a service called renting out properties, and therefore the costs of doing that are naturally allowable against tax. But when governments then try to tax buy-to-let, which they have done in a number of places, Scotland and Jersey, where I do some work, by putting an additional tax on the purchase and then disallowing interest as a cost when it manifestly is, you then get a collapse of the buy-to-let market. Governments are not desperately good at thinking through the effects of their measures.
No, indeed. I think the other factor there was maybe a bit later that the generation that had bought their house and had made substantial capital gains were in a position to saying, well, I've got some money now. What am I going to do with it? I know, I'll buy a house and let it out, rather than put the money in the market, in the stock market. And I think that is something which also drove the growth of that share of the market.
Yeah, I think that's absolutely right.
We're now at a situation where houses are about 9 times earnings. Do you think we'll see some sort of reversion to the mean, going back to towards the 4 times level that lasted for probably about 60 or 70 years before what happened in 2000?
First of all, of course, mortgage rates have doubled for many people, although 6% would have been thought of as a very low rate for most of the 70s and 80s. We got up to 15%. I remember announcing it to the media.
I remember reporting
and their cries of delight.
And I think that even that needed a subsidy from the government, if memory serves.
Tiny subsidy for a short period, but no more than that. But frankly, a 15% mortgage rate with 20% inflation is fantastic.
As long as you can make the payments.
Yeah, but what people knew then is that you only had the payments as a proportion of income were very high for about a year. And then you got your 15% pay rise and they went down. So that changed. House prices have been pretty static for the last year or so. Well, since interest rates shot up, the expectation is then, not going to go up massively. So I think we will see a reversion, but we're not going to see it back to where we were because we are still constraining supply.
Yeah, I think I agree with that analysis, and subject to the same caveat as the green belt has almost got the same status as the NHS nowadays, that it's sacred and must not be encroached upon, and woe betide any political party that says, right, we're going to build on it. The reality, of course, as we all know, is nothing like that. But the image that it has of these lush green fields surrounding the city is firmly in the public mind, and it's politically very expensive to try and change that.
Hang on, I thought John Prescott, when he was Environment Secretary, had said the Green Belt was a Labour achievement and we're going to build on it. It's one of his more famous contributions.
Yeah, and of course...
But maybe that's just Prescott.
And of course they didn't.
You've made a very eloquent, persuasive case that the government has done lots and lots of things without really thinking through the overall effect of its interventions and actions. One thing which the government has done in the last few years has essentially, if you like, been a series of policies which are sort of designed to prop up house prices, the most obvious of which is the equity loans which were offered to investors who couldn't otherwise, or buyers who couldn't otherwise afford to the deposits on their mortgages.
You're talking about Help to Buy Builders Yachts, aren't you?
Help to Buy Builders Yachts. Do you think that they're going to back away from that? Do you think that period is over and there's an acceptance now that trying to prop up very high house prices is probably not a wise move?
Yeah, the Help to Buy Builders Yachts was an interesting policy. And speaking as a shareholder, modest shareholder in a few house builders, I thought that was fantastic. It's economics O level, if that, like probably kindergarten level, that if your problem is high prices, the ideal solution is not to subsidize people to pay them. But that is what governments do. Now, if they're closely targeted, they work for some people. Undoubtedly, the beneficiaries. But no, it's not a great idea to prop up house prices. But on the other hand, when we had in the early 1990s a sharp fall in nominal prices, there were some people who were very badly hurt and they were innocent victims. But again, it was all a consequence of government policy. And what we want, of course, is stable policy, stable economic variables. And then people's wealth at the moment is to a large extent determined by chance. So our generation, Neil, you and me, the beneficiaries of free university education, massive increase in house prices. And there's a lot of evidence now that today's generation will be poorer than we are.
To come back to really where we started, Mark, we've been discussing housing finance and to see, to what extent it contributes to this, what everyone seems to acknowledge is a mess, and whether there are things that we can do which would make things better. And to what extent do you see housing finance as the kind of cause of the problem? Is there anything that needs to be fixed? Seems to me that you think it's just responding to consumers' behaviour. But is there any change in the system that might make it function better?
I think it's responding to consumer behaviour and to other government measures. And when I joined the building societies in the 1970s, do you know what two of the big public policy issues I had to deal with?
No.
The first was the growth of building society branches. which was deemed to be killing the high street. Now, of course, the closure of building society branches is killing the high street. The second point, it was alleged that building societies wouldn't lend on pre-1919 houses, which was untrue as I bought one myself, and that they wouldn't make 100% loans. There was a government scheme to allow 100% loans to be made. Now, the building societies could be criticised for making 100% loans. Now, the problem at present we've had over the last few years, generally renting is more expensive than buying, because renting you are paying somebody else to manage and maintain your home. So the notion that people can't afford to buy, therefore they rent, is an absurd statement. The obstacle to people buying is not the mortgage payment, it is the deposit, where it is impossible for many people without a bank of mum and dad to raise the deposit. And then we get governments, the bit of government concerned with financial stability, completely unconnected with the bit of government that is concerned with housing, restricts what building societies and banks can do, or it imposes a higher capital requirement on high percentage loans. So if we are looking to try and equalise the position between the bank of mum and dad beneficiaries and the others, it is doing something about the deposit and the mortgage rate being geared very much to the percentage advance. Now, we know the percentage advance is linked to default. A lot of data on that. So some form of guarantee for the top end of the mortgage, which existed in the private market and from the government, is a way to help people overcome that problem.
That was A Long Time in Finance with Jonathan Ford and Neil Collins. Production and editing by Nick Hilton, and our sponsorship partner is Briefcase.News. If you enjoyed the show, please rate and review it on your podcast app, as that will help new listeners find us.